In this problem, we are asked to issue a bond with a face amount of $130,000 at an issue rate of 94. Later you'll see that that represents a percentage of face. The term is 20 years. And they are actually paying interest on a semi-annual basis, meaning half a year. So in reality, 20 years becomes really 40 periods. So we have to adjust our rates based on that. So instead of having 8% bond contract rate, that's for the full year, we're going to be using a contract rate for the period of 4%. Given that information, here's the answer. I'm first going to show you the measurement of the amounts that we need for the eventual journal entries. But let me show you the journal entries to begin with. Let me show you this one here. On a certain date, let me go check what that date is. On June 30th. So it's actually being issued on June 30th, so the very middle of the year. So I'm going to do a 630 here, like this, so you don't lose track. We are issuing bonds with a face of 130, that's given. The cash proceeds, meaning the price that we sold these bonds for, is based on the 94 given to us as the issue rate. Let me make sure that's correct. That's correct, yeah, 94. So we simply take the issue rate given to us of 94%, multiply it by the $130,000 face, the bond price or the proceeds we get from the investor. Remember that with the issuers, so we're going to be getting proceeds of $122,200. That's what this represents. Cash proceeds of $122,200. The difference between 130 and 122,200 is what we refer to as a discount. Notice that the discount is a debit normal balance account. This is a contra liability account. So between this one and this one together, it will always provide you with a carrying value, as you will see in the latter part of this presentation. With respect to the interest on these notes, let's go down a little bit, right about here. And let me just make it a little smaller so we can actually see even the calculation, hopefully. Notice that I'm using right there the contract rate of 4%. It again represents 6 months. The contract rate initially for the full year was 8%, so the 6-month periodic interest rate would be 4%, half of that. We multiply that times the bond's face of $130,000. That tells us that the interest payment to the investor from us, the issuer, each 6-month period would be $5,002. And that's the reason you see this credit to cash of $5,002. The cash payment or the interest payment on any bond is always based on the contract rate times the bond's face. That's always the case. Just make sure that you do using the right periodic interest rate. Now, the interest expense, as you can see right there, is actually more than the payment. And the reason is this, the difference between the face and the bond's price. Eventually, when we return the loan proceeds to the investor at the end of the life of those bonds, we're going to return not the $122,200, we're going to return the $130,000, the total face amount, even though they only paid us $122,200. So that difference is really an additional amount of interest provided to the investor, effectively raising the interest rate on the contract. Well, that raise or the rise of interest rate effectively represents higher interest expense every period. But we do not recognize the full amount at the outset of these bonds. Instead, we allocate a portion. Here's the difference, right? The discount. a portion of each of these, of this full discount amount, we recognize it each period. And so we use a very simplified method called the straight line method instead of the effective interest method. That's a more accurate and more interesting method, but for now we're using this one. So instead, we're simply going to say total discount amount of $7,008 divided by 40. So each 6-month period, we're going to allocate from this amount $195 to our income statement as interest expense, or as additional interest expense. And the way you do it simply is, again, here's the cash payment, $5,002. Here's the amortization, the reduction, the amortization of $195 from the initial $7,008, which comes from here again. So together, that would make up the total interest expense on those bonds each period. So $5,395. So let me show you now how that is reflected in the accounts. As you can see here, on issue date, or 6/30, we booked again the face amount into the bonds payable account. Given the discount that we already figured out was $7,008, the carrying value of those bonds was the difference between that $130 and the $7,800 face minus discount of $122,200. Now, notice how this moves in terms of the carrying value after the amortization of the first period. So at the end of the year, 12/31, for these bonds, we amortize $195. So the discount balance, or the balance on this account, the discount on bonds payable, went down from $7,800 to $7,605. Given that, the $130 minus the $7,605 gives you a carrying value on these bonds of $122,395. Again, face minus discount. Notice that it's higher than the initial value here. That means that as you amortize that discount, the carrying value rises. And after the 40 years of doing this, you will see that the carrying value goes up to $130, the face amount. It always goes up towards face. And then this becomes 0.